going to share my screen with you in just a second. Just waiting for the computer really to start up, everything to be firing. And we are live. So welcome to the weekly stock market update. Let me know where you're from. Put it into the little chat box as well. And I'm going to share my screen with you to show you what's fresh ink on some of the slides. Actually, you're really going to love this. We're going to look at 2026. We're going to look at where we are right now, how to improve those pensions, how to improve those returns, how to make sure we get the most out of this AI boom. Gold at all-time highs, copper at all-time highs, the US stock market at all-time highs, the UK stock market at all-time highs. How do we capitalize upon that if it's going to continue going forward in that direction, and make sure that we don't panic, we don't get bored when the inevitable pullbacks happen, so that we own things that we'd want to have more of if there's a pullback, rather than own things which we would panic at should they fall. And I'm going to give you the strategies and the ways in which to do all of that. So thank you all for being on the webinar. Thank you, Viola, Mike, Paul, Thomas. Got another Paul, Carwin, Andy, Derek, Bob, everyone else. Let me know if it's your first time on here as well, and do let me know in the chat box where you're from. Hopefully you can all hear me as well. Yes, indeed. So share my screen immediately with you, and we get on with it. Like I said, you might want a pen and paper. You might possibly want your computer, your phone, to take a shot of this now and again. If you see me looking to my right, it's because there are multiple screens, and I'm keeping an eye on all of it for us, because there'll be useful things that I want to show you at different times during the course of what we're going to discuss. So let's start off with, more broadly, the political atmosphere. It's rather good for the stock market. Interest rates, if they fall, that's the key focus of the market. If US interest rates fall in December, that's good, because we'll expect more falls. If they don't, then we'll still expect more falls, but probably in January, February, make them more likely. Both of those things are being interpreted as positive for stocks, because it would reduce the cost of borrowing, means companies will have more money to spend, means consumers would have more money to spend, except savers, of course. And it would mean government cost of borrowing decreases. So government would have more money to spend. More money, prices go up in nominal terms, stock prices go up, profits go up, etc. The concern is inflation, and it's relatively benign. Oil below $80, good for stocks. And you might say, well, what about valuations? Well, actually, companies like NVIDIA are making profits because of AI, and that's good for stocks. I posted this earlier on our private channel. Just share something that I posted there from the public domain. I didn't create this, it was from the public domain. And you can see AI stocks are the ones which are surging. And it so happens that those companies, which you would call AI related, it's been the case for over a decade. So for those people who say, well, should I wait? And data shows buying at all-time highs stocks is better than buying at all-time lows, just statistically. Companies which have gone up tend to go up, not guaranteed to, but tend to. Now, the volatility of that and the risk you can take will depend on the individual. Put it another way, if you own a house and you're not planning to sell in the next 10 years, what the hell do you care what the daily price movements are? In fact, you never check the price of your house unless you're looking at selling, or you're just curiously weird and want to check the price of your house for no particular reason. But with the portfolio, even though you're planning to hold, let's say, for 2 years or 3 years, people tend to check it quite a lot. And that's a bit crazy. Chetan from Bradford, welcome to you. Carwin, hello, repeat viewer. I know Paul, the kid, fantastic, from Borada, from Cardiff. That was my Welsh accent there. Okay, so that's good news. But the point I want to make to you is the names everybody's heard of have a monopoly on talent, and they have a monopoly on destroying competition. They'll either acquire the competition. If the competition doesn't want to be acquired, it's empire building. Doesn't want to be acquired, they'll first make that move to them. If they don't want to be acquired, they'll destroy them. Why can they destroy them? Because they've got deeper pockets than the competition. They can just undercut, underprice. They've got better people working for them. So if you can't beat them, join them would tend to be the direction things are moving in. If I just go for a moment to the public channel, you'll see I've written about why those profitable companies, the ones you've heard of, are not necessarily ones to shy away from. There's a group of retail clients who looks for unsung heroes, names nobody's heard of, in the hope they're going to get the next big thing. I'm not necessarily that person. The Telegram channel, by the way, the free Telegram channel is on alpeshpatel.com/links. You'll find it over there. Ooh, by the way, personal news update. I got an award from the Department for Business and Trade, the government's Department for Business and Trade, Head of Entrepreneurship, for lifetime achievement. That's usually the point where they think you can't achieve any more. So, but I'm incredibly grateful and very, very proud of that. Just another quick update before we dive into individual stocks. The pension age calculator and all the other tools, they're on campaignforamillion.com/tools. Campaignforamillion.com/tools. If you've used one of my tools on there, please, Carmen, I'm not pronouncing that. Prinawan da ichi. If you've not used one of the tools, let me know. But if you have, I'd really like to know what you think. We've got about 8 free calculators and tools on there, including upload your photo. I'll estimate your age. Though we haven't put a flattery filter on there where we basically estimate the age and we say knock off 10 years, make everyone feel better. And then it'll tell you how much you should have in your pension by now or not. Okay, so those are some important ones to let you know. And then the other updates I've put here and what I was up to. Who's that handsome young man? That's me, old man. On there as well. Okay, so that was to give you an update. One of the things we're going to look at is how do you convert all of that know-how into a pension? How do you convert that into, well, wait a minute, what would that mean in terms of holdings? Let's move that across slightly. Okay, what does that mean in terms of holdings? If we look at some of the client portfolios, 2025 to November, and we're going to update that by the time of the next webinar for up to obviously December. The 17%, 20s, 28s, and so on. How do you convert that? And I want people, one of the most important messages I want to get across is don't think at just the stock level, think at the portfolio level. Private investors go insane because they want their individual stocks, which make a portfolio, all to be up double digits, and they're gambling on the stocks. And then they panic on some of the good stocks, which have generated a lot of profits, and get out too early and double down on the losing ones instead of thinking, how's the portfolio at the top end doing? It's not just me who says that. Warren Buffett says that as a piece of advice as well. Stick to the top end. So going back to politics and the markets, where are we? China, Taiwan, no conflict so far. Not really something I'm worried about or anticipating. For defense spending, buoyant, that's spending. Spending means profits, okay? The circulation of money. So defense issues with NATO, Europe, in a way, it's good news for the stock market. So, as they say, war is big business. And the benign background is such that I'm not worried. So if I was speaking to you on my Bloomberg TV show, that's exactly what I would have said. And there was a reason why I did 200 shows, because it was pretty bloody straightforward and obvious, but some people didn't often say it. Now, as we go into individual stocks and so on, legally, I have to tell you that this is not individual stock advice. It is not solicitation to buy any particular security or sell any particular security. It is for information and education purposes as part of your overall process of you deciding what you want to do. If you ever need to get a hold of us, that's where we reside. Okay, now, before we look at 2026 and some of the stocks that I hold, on which direction I think things are going, how we protect in an uncertain world where I don't have a crystal ball or time machine as to what's likely to happen, but I'm going to give 2 scenarios. The rising scenario is the easy one, but I'm going to give you the more important one. What if we get another 2022? That's my biggest worry. 2022 repeats itself, and I'll show you what that means with some charts in a second. And what do we do if it repeats itself? But before we do that, why is anybody even here? We have 2 types of people. We have the Hargreaves Lansdown type who want to do it themselves and then discover that they don't have a process and they don't have the data or the know-how or a process, so they keep effing it up. Or you have the St. James's Place clients here, who are the ones who've given it to a wealth manager or a fund manager, and those people have messed it up. Now, you might be a dentist, i.e. time poor, cash rich professional. Dentists and accountants are particularly big with us, and doctors. Or you might be a retiree. That's another big category we have. Or you might be an entrepreneur who's got their own business, worked their ass off, and now thinking, shit, I really ought to be making more of my money because I can still double up my income every 3 to 5 years. So that's the category of people we've got. And the reason we have those people, very simple reason, I've put some of the data in here, is fund managers underperform. Now, to remind you why they underperform very, very quickly, I know I've said it a million times before, why do fund managers underperform? In down years, like 2022, they can't go into cash because their mandates don't allow them. So I always give Meta as the classic example because it's a very well observed company. And in 2022, in that year, it fell 63%. Peak to trough, it actually fell 76%. Now, we didn't see the tops or the bottoms. The only reason we exited this, and you can see the YouTube videos and all the rest of it, is because it was a daddy bad. Okay, when you get a crossover of the short and medium term stock prices, as you can see there, the green goes below the blue. Generally, I want to be thinking about exiting, especially if it's happening in multiple stocks. And the reason we got back in over here for a roughly 173% return, it was slightly less than that because we got in a bit later. So 100%. Okay, the reason we only doubled the money that year was because once this then starts rising, the green bottom up there, that's the earliest we'd ever think about getting back in. And that happened across several stocks at the same time in January of 2023. Did I know it was going to drop 63%? No. Did I know it was going to go up 100%? No. Okay. If I knew those two things, which is an extra level of prediction that retail clients try and do, then I would have gone to Ladbrokes and made $1 trillion in profit because I would have asked them for $1 billion in one odds investment. Fund managers hold across those cycles and get 0% in 2 years. Okay. So that's one key advantage we have. But that opportunity only comes up once every few years. That was 2022. So what about the rest of the time? And how do you even manage your own SIP or ISA or decide how to buy stocks? Well, that's the easy bit. It's like opening a bank account and buying something in a shop. So I'm not even going to go into that. That's how easy it is to open a brokerage account, whether it's a SIP, ISA, tax-free account. That's how easy it is. But what I'm going to go into, how do you know which ones to buy, we'll go into, and which do I like? But don't think at the stock level like some breathless newsletter vendor, motley fool. You must buy this stock. If you wonder why they're breathless, it's because, they're probably on too much caffeine or something harder. It's because they've got to keep keeping you subscribed. They've got to keep you subscribed by promising you the next thing, the next thing, the next thing. So don't do that. Equally with the fund managers, they can't go into cash is one major problem. The other problem is they have so much capital to invest because they get paid as a percentage of the assets they have under management. Okay, so they have to maximize those. So they have so much in management, they invest in individual countries or individual styles or themes. So growth or just UK or just Europe. And that means they're picking for a narrow gene pool, which means they might get lucky one year. But most of the time they're picking, it's like trying to pick the World Cup winning football team, but only out of Watford. Okay, so I've mentioned that many times before. And I'm going to move on now that I've set the context. And it's a £10 billion problem. That's from AJ Bell. 9 out of 10 pension funds have underperformed. And I think the only answer to that is do it yourself. I mean, these books that I wrote, you can download a free copy of that. I'll give it to you in a moment. Well reviewed by the FT and Bloomberg and multi-billion-dollar hedge funds as well, is you can do it yourself. You can learn to drive. You can learn to drive. You can invest. Forgive me if there's anybody on here who can't drive. Okay. Thank you, Bob. Over the past years, heartfelt thank you. Oh, thanks so much, Bob. Oh my God, that is such a nice thing to say. I really appreciate that. Feedback goes so well for me because it allows me then to know, do more of this, Alpesh, take your time out to do it. The Great Danes of underperformance, i.e., which are the dogs? And they're often names you've heard of. Now, I'm not the only one crusading on this. Eugene Fama, Nobel Prize winner in economics, he crusades on this, that fund managers underperform. Warren Buffett crusades on this, saying fund managers underperform because they will naturally pick from a very small group, UK growth. You might say, what's wrong with you, Alpesh? Rachel Reeves wants us to invest in UK growth. My job is to make money for my family. Okay, I have lots of other jobs. I have a responsibility to society to do philanthropic work as well, because I'm in a very privileged position. But that's separate. My initial job is to make, like yours is, to make money for your family, protect your family. Okay, try to begin at home. Smallest circle is your family. So I on that, wherever I make my money from, whether it's UK companies, US or global companies, which make the top 20, that doesn't matter. And most people don't even realize their SIP and ISA can go into US companies, for instance. Now, I'm not biased towards the US. As I joke, I'm not racist. I don't say I only want Americans, not British people in my fund. Actually, given that I live in Britain, if a load of Americans are working for me and making me profits, and I bring that money here and I go spend it in, whether it's Waitrose, Harrods, or Lidl, incidentally, I really like Lidl. It doesn't matter because it's in Britain that I'm spending it. It doesn't matter where I made my money. So we don't need that level of patriotism to sacrifice our pensions and give it to a UK company if we want to go where the money's being made and bring it back to Britain and spend it here. So these really massively underperform. 10-year total return, that's 10-year total, not annualized, total. And every one of them just underperform one simple index. You might say, well, wait a minute, Alpesh, do you know all the managers in this go to the right universities? How the hell did they underperform just an index tracker, passive index tracker? Yeah, I know. It's because they were told by Scottish Widows or Standard Life, you're only allowed to, first of all, you've got to hold a load of cash, and you're only allowed to a load of cash according to their plan. So if they're in very low risk, they might have 40% bonds. Okay, but if they're in high growth, they'll have next to no cash, but they'll only have UK companies to pick from. Well, the growth companies are not in the UK. So what can you do? If they are in the UK, it doesn't matter. I'll get them on my filters. I'd still get them. I'll just show you that in a second. Let me just show you. Give you an example. Okay, we'll get them if they're in the UK. None of these fit our criteria. Just to give you an idea how stringent we are. Okay, LSE is the blue ones. Now look at this. Okay, none of these fit. But I'm saying we'll get them if they do, if they move up the league table, as it were, of football. But the reason you need to look at 10,000 companies to state the obvious and why so few meet our very strict entrance criteria is think of it as like a university. These companies want to manage my son's inheritance. They want to manage my old age retirement. So I'm going to look at their CVs, every single one of them. I want the best in the world, not just British ones or Japanese ones or Chinese ones. So the lie you've all been told is, oh, if you get a UK fund, a US one, a Chinese one, and a growth one, you're diversified. Well, no, that's like saying you can only pick a football team with the goalkeepers out of Watford, the forwards out of Belgium, okay, the defenders out of Lille. You're diversified. You'll have a world-class team. Stupid statistics. People don't understand statistics. So getting into 2026, what's my outlook? Well, first of all, my outlook is I'm going to manage my own money as the SIPs were created by whichever chancellor. Was it Nigel Lawson when we had, what were they called? They were called something else back then. Were they SEPs or something? Anyway, and ISAs, they were created based on a US model of tax-free pensions and savings. They were created for you to do it yourself. I'm going to give this away for free. I'm not plugging my book, okay, for free. And you know, when you get older, the only thing you've got is a desire to be relevant. Okay, I know this because I always used to sit around wondering, why do all people give unsolicited advice? And then I realized they just want to feel relevant, important. They've lived a life. They've got experience. They've got something to say. And you know, when you're young, you go, oh, shut up, old man. What are you going on about? Who asked you anyway? So I love social media because I can still stay relevant. Okay, so 2020. Well, look, the worst alternative is I might have gone into politics. Bloody hell. 2026 investment outlook. Now, the individual stocks I select, they have to navigate this. This is the mistake retail clients make. It's a very subtle mistake, but it's a very important one. The retail clients think they've got to pick the companies which will benefit from these things. No. You've got to pick the companies who know how to benefit from these things. So when I invest, say, in Microsoft, and it's in the public domain, I own Meta, Microsoft, Apple, Amazon, Alphabet, Nvidia, Goldman Sachs, JP Morgan. I've mentioned it many times before, and a few more besides. It's for the board of directors of Microsoft, Satya Nadella, to take advantage of this, okay, to take advantage of 175% power demand growth and therefore buy the nuclear power stations as Meta has done. It's not for me to solve the problem for them. I don't go to the board meetings and say to this chief executive of Alphabet, let me run the company for you. Now, I'm not the first person to say this. In fact, everything I'm going to tell you, somebody far cleverer has said than me. It just so happens I came to it independently and then found, oh, there's nothing new under the sun. Hang on, Warren Buffett said that. He said, you want the kind of company where you can trust the management to get on with it. And you're not micromanaging or interfering. Notice how the guy doesn't say, oh, I then go meet all these companies and then tell them how to run their business like a venture capitalist or somebody in private equity. Okay, it's not what we're doing. We're very hands-off, which is peace of mind. Now, when you have reframe it into that way, you suddenly start realizing, hey, shit, my job's a lot easier than I realized. Okay, and it is. So whilst this is great news, there's going to be more mergers and acquisitions. Tariffs are not impacting the stock market. In fact, with lower interest rates, what the taxation in the US is doing is taking some money out, reducing the budget deficit, which the market's happy about, putting a brake on some of the spending which lower interest rates are providing and the high profits are providing. So the fact of the matter is, Donald Trump perhaps should get the Nobel Prize for Economics. For this reason, I know it's laughable. For this reason, either he has worked out that what this economy needs is higher taxation. And instead of calling it like we did in the UK, oh shit, we're up the creek, we're going to need more tax, the whole economy is broken, I've got to tell you it's really bad. What he said instead was, listen, we've got an incredible economy. I'm going to put tariffs because we're going to punish foreigners. Now, economically, he isn't punishing foreigners, he's punishing domestically. But what he was saying, the same thing that Rachel Reeves said, we're going to put up taxation. Except he framed it in a way where people were happy to pay. I don't think he's that much of a genius, because I'm only working it out in hindsight and I'm not a genius. But the framing has been he's a lucky fool, perhaps. The framing has been absolutely insane. Sorry, my image might go off for a second. The video might go off because the camera is too hot. I've had it on for a while. I'll turn it back on in a second. Okay. Anyway, the point is that is good for the economy. It is good for the economy that 9 out of 10 G10 countries have cut rates in 2025. India has just cut rates today. That is good because lower interest rates mean more money in the economy. $100 trillion in global government debt might worry you. It should, except you do want something to manage expectations, to taper them. Now, I don't worry before I have to worry. I don't worry that if I set off from Leeds to London, there might be fog in Manchester, or which isn't on the way, or in Leicester. You're just driving down the road and you look at this every day and you say, well, no, we're all okay. 27% of S&P 500 capital expenditure comes from AI firms. That scares people. What it tells me is those companies have got a massive monopoly. They're soaking up all the profit-making tools so that they're the ones which are the safer bet. Now you might say, no, Alpesh, there's a small, tiny little rare earths quantum computing company you don't know about. Yes, but I'm not investing at that. The talk I gave at Level 39 was with Canary Wharf this past week, was with startups and scale-up, small companies. And I said, what you're competing against is my holding of Goldman Sachs, which last year went up 50%. Should I give my money to? The angel investor with a good idea, the angel company, the startup with a good idea, or Goldman Sachs with a 50% return? And I explained to them, I can't do this philanthropically. I need to make a return. Okay, so it's exactly the same mindset, okay, that I want you to have. Aaron, I'll come to correlation in a second. Usually correlation, you can compare intra-stock, i.e. between the stocks, or to a benchmark like, say, the S&P 500, to make sure that they're not highly correlated. However, what you really want to look at is how correlated are they when the markets fall, because you actually want them to be very highly correlated when the markets are rising. Obviously, nobody wants diversification in a rising market. You want concentration, because what does diversification imply in a rising market? That some things are falling. Duh, why would you want that? You want it in a falling market, which is the time you least get it. I wrote about that in one of my Financial Times columns. I didn't invent that. I didn't discover that. I found somebody else's research and published it and vocalized it. This is what I'm doing now. This is other people's research, which I am amplifying. Let's put it that way. 2026 investment outlook. This is a combination of my own views, Goldman Sachs, and Morgan Stanley. Okay. And there's enough, well, there's a lot of positive news. There's a little bit of negative. Let me just tell you some of the things which are coming to mind. First of all, am I really going to invest in Japan? Not so much. Europe has been doing okay. It's still whichever are the quality companies, and they're still probably going to be US large caps. All right. So I'm fine with that. Morgan Stanley think the stock markets are going to go up about 16% next year. The mounting debt and the tariffs acting as a positive. They're like a parachute or a drag, so people don't get overexcited, and we stay in that Goldilocks, not too hot. We don't get too carried away, and not too cold where we're just negative and everything's falling. Okay. Yes, there are geopolitical risks. So these sort of negative factors, however, the mega trends are that some countries have just got economic resilience, like the US. And you've still got all this infrastructure spending as well. There's a lot of activity in the economy. That is me listening to the broader background music. I don't need the minutiae. Would I go into emerging markets? Well, they reckon there's more money there, but everybody always reckons there's more money there. It's not for me to go into emerging markets. It's for Microsoft to do it. Earlier this year, Microsoft said they're closing their offices in Pakistan. I'm not going to second guess them and say, well, actually, I'm going to invest in a Pakistan stock market index tracker. I'm just going to say, well, it's your job to work out whether you want to be in those markets or not. And I will reap the benefits from you being there. I'm not here to gamble or speculate. I'm here because it's a pension and so on, to take less risk than just speculating. I mean, if you wanted, I could probably come up with some crazy AI names which nobody's ever heard of, but you'd probably say to yourself, God, thanks, Alpesh, but I don't want to put too much in there. So this is some of the background. We're not going to read all this. I've got a master's degree in economics. I'm not going to read all of this because it's not relevant to me making money. What's relevant to me making money? My economics tutor at university told me this. He said, look, all you're going to learn economics is not relevant to making money in the stock market. I said, yeah, I know. What is relevant is undervalued growth. Is that green? Those 5 columns have to be green. And out of 10,000 stocks, our entry criteria, well, basically, let me put it this way. It's easier to get into Oxford University than get into my portfolio. It's probably easier to get a Nobel Prize in economics than get into my portfolio. It's about 100 to 200 stocks out of 10,000, which will be green. Okay. Those odds, easier to get an Oscar than to get into my portfolio. And of course it should be that hard, because guess who my portfolio is for? My son. I said to my wife, I feel I am working, my son's 7. 10 years ago, I said, I would have thought to myself, there's somebody not even alive that I'm working for. That's nuts. Then again, I looked at my tax bill. There's a hell of a lot of people I'm working for I've never even met. Value, growth, income, cash return on capital invested. You want that to be green. That comes from Goldman Sachs. Momentum. Sortino is high average returns, low downside risk. Okay. In other words, average returns everybody understands. What they don't understand is when a stock falls, you want it to snap back quickly with not a deep fall. Can't guarantee it, but that's what you want. The reason we want all of those things is because we don't need to worry about this. Who's worrying about this? Those companies are. And even they can't get it right. Think of this. Warren Buffett, in becoming the world's richest man, never once had the top 10 best stocks of any given year in his portfolio. He never had a portfolio where every stock went up in any given year. And yet he became the world's richest man. And I bet you if there was an easy way of doing it, like retail clients try, I must get the best performers and the 10 baggers, then he would have worked it out because he's got the billions to work it out. What else do I see? Well, I still see 2026, Europe is going to continue dominating. Even more so, they are accelerating away from their nearest rivals. The money, they're soaking up the oxygen out of the air. That doesn't mean we don't look at European stocks. We have some, and British ones, which are relatively, they're okay. I don't happen to own any of them just because I've got my hands full. Anyway, I'll give you an example with the UK ones, with the FTSE 100. They have to be all green. Okay, I don't want them because I've got Diploma comes close. That sort of hits the mark, doesn't it? Diploma, Fresnillo would, but it's a bit too volatile for me. I've got better options. Okay, and then I think that's about it, I'm afraid. So they're not all green. Sorry, I'm not going to randomly pick ones which don't meet all the criteria, because the ones that meet all the criteria will, as I'm going to show you in a second, generate me 30 to 40% per annum on average per annum in an up market like 2023, 2024, 2025. We'll get the results. We'll see what's happened. What's the backdrop to all this? More profits, more spending. People are spending, profits. I don't pick sectors. I couldn't really care less. People think, oh, well, if you pick diverse sectors, you've got correlation. Really? Well, if you had so much correlation, how come in 2022, every single stock fell? Pretty much 90% of stocks fell. Where was your correlation? Where's your non-correlation and diversification then? China and America fell. When you needed it the most, it went AWOL. It ran off like a little coward, little diversification bunny bear going, oh my God, no, I can't hang around these falling markets. I'm too scared. It wasn't there. So when fund managers talk about diversification, they're marketing to you. They're trying to sell you another product. We know this because the data contradicts their narrative. And when there's narrative and there's data, always go with data. Okay? Right. 10 commandments of investing. Please, please, please keep these. Oh, brilliant. Carwin, thank you for the feedback on the illustrative graphics. I'll keep more of those going actually in future. I will as well. Paul, I'll come back to yours. You will get a MACD only in a moment. Paul, I'll show you that. I will answer all these questions as well. I'm not going to go through all of these. I want you to remember these. Well, you can take a pause and a picture. It gets you closer to the heroes of investing, you know, like I say, the Warren Buffetts, the Charlie Mungers, the Benjamin Graham types. Okay, we're not here to trade, as it were, right? That we can put to one side. This is more important. I show my clients this. My clients won't get upset if I show you this because it's not stock specific as such. Ask yourself these questions. What should I do? And regret minimization is a more important framing for holding a portfolio. You know why Warren Buffett's a genius? Because he claims, and he's not telling the truth when he does this, he claims his favorite time for holding stock is forever. We know he doesn't hold stocks forever because we know he doesn't. Okay. But the genius of what he's saying is, the implication is that he doesn't panic and he doesn't get bored. Because if you say you're going to hold something forever, you know, like, I'm going to marry my wife forever, that means I won't panic, sweetheart, and I won't get bored, sweetheart. That's what he's actually saying. In other words, I won't panic and sell, and I won't get bored and sell, right? And that's what, if that's the case, then regret minimization, when you haven't got a crystal ball or a time machine, is a better way of looking at the market. So you can take a picture of that. And also, I'm often asked, how should we enter Alpesh? Should we go all in or not? So most people are going to be this or this. It's as simple as that. You're going to be one of those two. Here's the drawbacks to both. I can't remove all drawbacks. The only way to remove all drawbacks, which is what retail clients want, is having a crystal ball. I don't have a crystal ball or time machine. As I've said time and time again, I forecast and predict a lot less than people think. Okay. In fact, I forecast and predict next to nothing. What I do is say, I've got a resilient portfolio. I've got an umbrella. If I don't know when it's going to rain, okay, I'm not the weatherman. People think I'm the weatherman. I'm not the weatherman. I don't know when it's going to rain. I've got a bloody umbrella in my hand, so I've got a resilient solution. If it rains, I'm okay. If it doesn't, I'm also okay. I hope it doesn't, but I can't control the weather. And the market's the same. My umbrella is my portfolio. I'm not the weatherman. Retail clients try to be the weatherman and decide whether or not they should take an umbrella out. Guess what happens when you do that? And you start doing that when you're sort of young. You sort of risk. Should I take the umbrella? Should I not? Let me forecast the weather. Oh shit, I don't think it's going to rain. Looks all right. And you get soaked. Whereas if you always have the umbrella, the resilient portfolio, you don't care whether it rains or not. And I love these webinars because I come up with analogies, which in hindsight, I think to myself, bloody hell, that's a good one. I need to put that down on paper. That is the way to think. It's the way Warren Buffett also thinks. Okay. So where are we at the moment? Your average investor is going to be taking path A. When the market inevitably has a pullback, and it will, path A is what they start doing. My clients, I try to get them on path B or path C. Okay. And I'll give you a classic example of the two things. Well, I'll give you an example of the only three things which can ever happen in a market. Now, this is gold. I don't think I've ever covered this bit, though. I'm going to show you. Okay. I'm going to show you. Right. Now, there's only three things that can ever happen in the market. One is you have a deep, long fall, 22% over 1 year. Second thing is you have a short, sharp fall, 2 months, 20%. Third thing is, well, you go up. Now, you might say, no, Alpesh, there's a fourth thing. You can go sideways. Okay, I'll leave that for a second, just for a second, okay? So my job, when it's going up, I couldn't care less. When it's going sideways, I couldn't care less. Well, it's out of my hands. The only thing I've therefore got to decide with the quality companies that I've got is if it's going to fall short and sharp or long, I don't know which of those two it's going to be. And the classic example was this year and 2022. This year, it was short and sharp. I didn't know it was going to be short and sharp. 2022, it was prolonged. I didn't know it was going to be prolonged. All I knew is if that happens, I probably want to get out, as we did then, and then buy back cheaper. When we did that here, we ended up buying the insurance, selling, and buying back more expensive. That's the premium. Now, some students will say, well, screw that. I'll just hold on then through all of that. Yes, but if you get one of these, you'll get 0% over a long time. That's the risk you take. And if you get one of these, you're fine, V-shaped. So what do? Some will do. So you've got three choices. Either just buy and hold through it all with the risks of having no returns for 2 years. 2, sell, just in case it's a deep one and you can buy back cheaper, but you might end up buying back more expensive. Or 3, probably the right one, regret minimize by doing 50-50. If you get the daddy bear, which is that. By the way, I'll remove the weekly. There you go. This is TrendSpider. You don't have to use TrendSpider. You can do TradingView. You can do it on Yahoo, actually. Okay, there's the monthly. All right, simple for the moment. Right, so path B or path C. How do you decide which one's right for you? The mistake retail clients make is they think your job is to see into the future and know which is right. You only know in hindsight which is right. Your job is to regret minimize and keep calm. Why keep calm? Because a pension is not just about being happy at the end of the journey and the money you have when you're 95. A pension's about making sure you're happy every single bloody day. Okay? I'm happy. Look, Warren Buffett's 95 and happy. I'm happy because I know the compound rate of my portfolios. So I wake up in the morning and go, well, I got that sorted. I've only just got my bloody will sorted. So you can imagine these things, they bug you at the back of your head. But the portfolio got sorted a long time ago. Most people haven't bothered to do that. What we're trying to do is out of every feasible model of portfolio, from 10% annualized return to 30, and we certainly don't want the 10% ones. So we want to ditch anything below 25. So anything below 15, we don't want those models. And we certainly don't want anything with a volatility above really 25. So we're only playing in a very, very small group. 25 and 10, 25 and 15, 25 and 20 we'd get rid of because we can get 16 or 17. 25, well, 30 and 10. I always used to joke, if we get that portfolio, I should get the Nobel Prize in economics. We managed it. But there's no guarantee of the future. So what we then do is we assume that the volatility and the drawdowns implicit in that will double and the returns will halve. Well, if the returns on the long-term portfolios halve, then I still double my money in 5 years. So $1 million becomes 2 million in 5 years, 4 million in 10 years, 8 million in 15, 16 million in 20 years. That'll do. And that's just the long-term average of the S&P. If there's a tailwind, like we've had the last couple of years, then it'll happen sooner. Either way, it's more money than you need anyway, so it doesn't really matter. Most people, and I've also done in my TEDx talks about how much money you need to be happy. And again, that was from Nobel Prize winning literature and research. And I've done some articles on that as well. And it's less than people think, but it's getting there. That's the difficult part. Getting from 0 to 1 is the hardest part. From 1 to 100 is just greed. Okay, so where are we at the moment? Now, this famous image, which I've talked about and written about, I'm going to try and put the camera on again. I think if the camera's cooled down, I probably need to get a thingamajiggy, a cooling thing for the Sony. Yep, there we go. It'll come on for a few seconds before it has a tantrum. So this is famous now. Lots of people say they absolutely love it. Where are we at the moment? We're at 1. Now, we've been at 1 before. We were at 1 at the start of this year, and we were at 1 at the start of 2020. Well, at the end of 2021, we were at 1, and at the end of 2024, we were at 1. Now at 2025, we're at 1. So at the end of 2021, 2024, and 2025, those 3 years, at the end of each of those, we've been at 1. What does 1 mean? Rising but overbought MACD, which is measure of short and medium term prices. Risk-averse people will be cautious or stay out. Risk neutral will add to winners cautiously. Risk-loving will buy because they always buy. There's a 70% chance of a 10% drop in the next 6 months. Okay? And you might say, well, hang on, Alpesh, that's very clever how you frame that. Yeah, because I don't have a bloody time machine, but I do know statistics. And I know human bloody nature. Okay? So that's where we are. When will we be at 2? Well, when there's a flattening MACD. Where are we at the moment? Let me give you the live version of this. And by the way, for those who want it, Carwin, I know, Carwin, S&P playbook, frame it. It is. To be honest, if you did that and nothing else, it'd make you rich. I wrote about it in my first book in second book in 1998, Trading Online, international bestseller. And I've mentioned it in various bits ever since. You know, find your investment exit strategy, the bear framework. So there it is. Take a picture if you wish. It's putting it into sort of image terms. I handhold my clients through this. Okay. Free education for everybody. Those who want the personalized service and handholding, they have me. They become clients. So there you go. That's all the sort of the bits that I've just explained, the mummy bear, the daddy bear, and the do nothing, because that's the alternative. And there's pros and cons of everything, and you don't know except in hindsight which is going to be the best one. But when you've got clarity, frame it and print it out. I should actually have this in my son's sort of playroom, you know, on the wall. And then when he grows up, he can give the legendary story of, well, so how did you, Rian, become so good at investing? Well, my dad used to convert kiddie stories into stock market analogies. And I've actually done that on LinkedIn. I've sort of created the Star Wars version of the stock market, and just to educate people. In another lifetime, I'd be a children's author, I think, as well, because with my 7-year-old son, we do often talk about it. By the way, he has a lot of fun. Somebody once said, oh, bloody hell, give the kid a childhood. If you saw how much fun that boy, we were at Harry Potter World recently. S&P 500, so where are we? Well, you can see where we are and you can compare it. We're not in a daddy bear. We're not in a mama bear because the prices are not moving lower. We are overbought though. So would you exit now? No. There are only 3 decisions to make: buy, hold, or sell. Would I buy more cautiously, as I said? Would I hold? Yeah, because I haven't got an exit. Would I sell? Well, no, I'd have to be pretty scaredy pants to do it. If you sold off the back of just this, then you would have exited and got whipsawed so often, which is why private investors so often lose money by being out of the market constantly because they try and time it and they don't know how because they look at the wrong thing. They look at the weekly instead of the monthly. They're not physically look at it. They mentally are attuned to the weekly average prices. It's just how their minds work, not the monthly. The monthly, look how calm that is. It's like Buddha, Buffett, and Patel. That's what that is. We should start an investment firm called Buddha, Buffett, and Patel. Okay, I'm on fire today. I'm on fire, people. Buddha, Buffett, and Patel are calm and relaxed, right? The retail client is, I've got to sell, I've got to buy, I've got to sell, I've got to buy, I've got to sell, I've got to buy. Oh my God, oh, what's going up, going up? Guess who's going to win? Guess who's going to win? The tortoise or the hare? Buddha, Buffett, and Patel are the monthly one. They're the tortoise. Just calm, cool, collected. The hare, got to go here. The Mad Hatter, we took Rian to see open air production of Lewis Carroll's Alice in Wonderland. So the Mad Hatter is the weekly, and that's the frequency at which the retail client is attuned and panicking and getting wrong-footed. And you can physically see why now. Whereas the professional, or to be honest, myself and Warren, now that Charlie's dropped out of the relationship, it's like that. Okay. Thank you, Arun. My job is to try and communicate as well as I can. I don't always do a great job, but sometimes I do. Now, this is brilliant. This is really important. What is this? This is how much you're paying for every future dollar of profit in those companies. So it's another measure of valuation, or PE ratios, price earnings ratios. NVIDIA, you're paying $24 for every $1 of future profit. Think of a house. It's got $1 a year rent. You're paying $24 for it. Okay. You're paying $24 for it. Okay. Now, it's just reminded me of things. 1, 2. You're paying for Microsoft $26. Now, here's the interesting thing. Microsoft's cheaper than NVIDIA. Microsoft's more expensive than NVIDIA. So is Oracle. So is Palantir. So is Apple. So everything is more expensive than NVIDIA at the moment. Now, you might have some conspiracy theory to that. Or you might say, hey, Alpesh, fill your boots. That's not the basis on which I'd buy, though. It is only one of the many columns which has to be filled up. Okay, it is only one of the many columns which has to be filled up. And here's something that's also interesting. Walmart and Costco, you're paying more for than you are for NVIDIA. Now, you might say, wait a minute, Alpesh, it was an arbitrage opportunity here. We short Walmart and Costco, and we go long NVIDIA. Yeah, that's a bit sophisticated. Leave that for now. We've got quite a few earnings coming out this week. AutoZone's good and important, or next week rather. What else? Adobe and Oracle. Oracle's the biggie. I might do more of those stock of the weeks with Oracle's results coming out next week. They've proved rather popular. Now, this is really important. I know I say that about everything. I love this stuff. Okay. This is what I want to show you with this. Okay. The bigger the circle, the more it moves the S&P. Where's the S&P so far this year? It is here, this dotted line. How many companies are underperforming the S&P? All of these. How many are outperforming it? I think fewer. Okay, which is the best performing sector? Would you say? I don't look at sectors. Remember, in every sector that stocks which are underperforming, stocks are outperforming information technology. Don't start forming theories. Private investors like to come up with lots of theories on a small amount of data. They come up with lots of theories unnecessarily. What does this tell you? It tells you that you're going to find it very bloody difficult to beat the S&P 500 unless you own the stocks I own, which are Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA, amongst others. It's going to be very bloody difficult because those are the ones that move the S&P. The S&P is actually an index of the stocks there. But beating the S&P, as Warren Buffett has said, is pointless. That's not what you're here for. You're here to meet your own goals, not some arbitrary. Why not say beat the NASDAQ 100? Raise your ambitions instead. It's your own goals that matter. That's why those campaignforamillion.com tools are so good, because we created, and I made them completely free, I have had so many people say to me, are you insane? You could charge money for these. So we created a whole bunch of tools which are completely free. Okay, pension calculator, safe withdrawal calculator. Now this one's important, sequence of returns calculator, because you can play around with all of this. It's all free. Don't even want your email address. Okay, don't want anything, and it'll show you whether you're going to run out, what the probability is you'll run out of money. Because what if you withdraw money each year, but you get the bad years first? Well, how do you know it's going to be a bad year or a good year? You don't, but you know what the volatility is. And it's like heads or tails. You know it's only 50-50, but what if you threw 3 tails in a row? Do you see what I mean? That's what sequence of return risk is. We created that for free. IFAs and wealth managers want to charge you a fortune to give you that same data and information. And guess what they do at the end of it? They don't bloody go and explain any of it anyway. Guess what we do? We explain it. And guess what? We do it for free. In fact, we say, don't even need to bother us. It's there. Play around with it. Play around with it for your brother, your sister, your cousin, your aunts, uncles. Okay? Be our guest. It's not the only one we've got. For the younger ones, we've got the financial independence calculator. How much do you want to retire? How much do you need for your lifestyle? And this one's a bit of fun. Upload your photo, and we'll tell you how close you are to what you should have by your age in your pension. And of course, we've got the classic pension calculator, which actually you can get for free anyway, generally. But the other ones you can't. The other ones, IFAs charge you a bloody fortune to give you that same information. I don't think mediocre people like IFAs, mediocre service providers like IFAs, should be holding knowledge from people and then saying to them, I'm not going to give you stuff like that for free. I'll give you the book for free as well. We have 1% of people who will convert into saying, I want to be a client. We'll have 99% who will say, thanks for the free stuff. It's all fine by me. Okay. Last week, that's how it was. Lots of green. Don't read too much into 1 week. It's noise. We're not here to trade. It's our pensions. We're here to invest. Past year, look at how low those moves are. For a lot of this year, by the way, Apple was 0%. Look at that. That's actually had a big year, and it's still not gone up much. Okay, my Goldman Sachs holding, as I said at Canary Wharf, where I gave a speech this week, has outperformed my Nvidia holding. Alphabet's up 86%. Did I know Alphabet was going to go up 86 and Microsoft only 15? No. If I knew that, I wouldn't have held any bloody Microsoft this year, would I now? Got it? I am not smarter. If I was smarter, I could see into the future. I can't see into the future. It's a bit like when people say dolphins are clever. I mean, I'm sure they are. It depends what your metric is. So I would say I'm not clever. If I was really clever, my metric is if dolphins were so clever, how come they don't talk? And you might well, they do. How come they don't speak English? Similarly, if I was so clever, how come I don't have a time machine? I don't, where I can see into the future. I do. It's just with Quick Fit getting repaired. Exchange traded funds, I will do this once a month. I'm just going to share that for information. You can take a picture of this if you so wish. I've got people asking me about gold. I've been told by a gold refiner, let's see if he's right, in the next 3 months, it's going to go up 16 more %. It doesn't mean I go buy it, because we've already got some. You should have about 5%, they say, max in your portfolio, if you want any at all. Silver's also all-time high, so is copper, but I'm not chasing momentum, because momentum is only one factor that moves markets. Amazing. NASDAQ's up 22% so far this year. But that's the V-shape where we didn't know whether to sell here just in case we could buy back cheaper later and it was a deeper fall, but pay the risk premium of having to buy back more expensive if it didn't. And indeed, for most of the stocks that we exited, we ended up buying back more expensive. Because you'll remember I kept a couple that I didn't exit, Goldman Sachs and JP Morgan, and it transpired that that turned out to be the better thing to do because I didn't know whether it was going to be V-shaped or U-shaped. It can only be one or two, V or U. Okay, can run through the letters of the alphabet if you wish, but it's going to be V or U. Price to earnings ratios in the US market, you're paying 31 on average for every dollar of profit. Guess what? Nvidia is cheaper than the market as a whole, just so happens. Sectors, I don't care about. I care about individual stocks because it's stocks that are in my portfolio that matter. Sectors are important for correlation, but they're not. Because wouldn't you rather correlate based on the stocks you hold rather than sectors, which contain stocks you don't even hold? So again, it's the stupidity of what people put out there. In the 80s, it was important to look at sectors because they genuinely were a proxy for diversification. But that was in a world which wasn't interconnected. Okay. I own all of those except Intel. Intel's had a good week. There's the UK market so far. Okay. There is, the recordings are always at alpesh.com/latest shares. So is the sign up. It's the link changes accordingly. Okay. That's the UK. I don't own the UK. I'll do separate ones on the UK at some point. I'll do it. And you might say, well, wait a minute. Why didn't HSBC hit your filters? Well, it got pushed out by, say, NVIDIA. Well, wait a minute. It did better than NVIDIA. You're right. That isn't a guarantee that just because something's in the filter, it's going to be the top 20 stocks or top 100 stocks in the world. It's going to be enough for me to double my money in 3 years if there's a tailwind and in 5 years if there isn't. Expectations. That's it. Managing my expectations, I'm fine with it. This is just for information. I'll do a separate one on exchange traded funds. Again, take a picture of it if you wish. At last, bloody hell, that's been a long time coming. CMC actually having a move up. I think for about, it's sort of not hit an all-time high for about 5 bloody years. Don't know what they're pissing around with over there. The others, we'll do a separate one. So NASDAQ, very similar to the S&P, as you'd expect. Now, here's the thing. Can that keep going up and up? Does it necessarily mean it's going to fall? Yes, it can. I'd say there's a 25, 33%, I'm guessing, of it constantly going up next year as well. It can do that. And when has it done that before? Well, it did it here. Look. And the trigger then was COVID, new money going into the market. What's the trigger now? Where's the extra money coming from? Lower interest rates, debasement of the international currency. I don't know. Okay, there's all sorts of conspiracy theories because the FTSE's done it. What the FTSE's done unusually is normally it gets to here and then drops. Comes along there and drops. There and drops. Except this time it did drop, but then it's broken out. And it's not had any fresh money coming. It might be a relief rally that Rachel Reeves has not done a quasi-Kwarteng and sort of tanked the economy. Maybe it's a relief rally. Whatever it is, maybe the US will do that as well. Excuse me, just because I've been speaking so much, just had a little orange. S&P 500, 2 times leverage. Now, don't do leverage. Nobody on here should do leverage. I happen to do it because I keep a very bloody close eye on seeing if this is falling, let alone this, and then I think about exiting if it is. But at the moment, I'm okay. That's going up. And whilst that's falling, I'm cautious, but I'm not out. What does that give me? Well, if you get it roughly right, you get from, what is that, 24,000 to 30,000 in under a year, which is what, a 33% rise, or 30% rise roughly. Okay. But if you get it wrong, you're going to lose half your money in a very short space of time. So don't do leverage. That's only 2 times. That's the most I'd ever do. So I do have leverage positions on Meta, Microsoft, Apple, Amazon, Alphabet, and on the S&P. So does my son and my wife's portfolios. But it is for those who are more advanced, not for anybody. It'd be irresponsible for me to suggest retail clients should do leverage. Because they just don't understand the depth of drawdown. Risk is depth of drawdown times duration. So bigger this square, longer it took to recover, depth of drawdown times duration, that's your ulcer. Call it risk or your ulcer index. Okay? Bigger that box, the bigger the ulcer index. And you really want securities where the box is below your risk appetite. So you don't get an ulcer. If it's more than your risk appetite, you get an ulcer. Okay, I'm going to create a little thing where we can put an app where you can actually put in your ulcer levels, and it shows you examples of what they are, and then it tells you which stocks match your ulcer. But anyway, we've got lots of ideas. I've got lots of bloody ideas. I've got to control myself. Look at that. It's just nuts. And that's another example of just flying through and just keeping going higher. And if that's an example of what's about to happen in 2026, then we're going to have some very good rises in 2026, which people are going to look at disbelievingly and be on the platform saying, oh, no, I don't want this. I'm worried. I'm worried. There'll always be some of those. The India ETF, just be careful with exchange traded funds in the sense that whilst you can apply this framework to exchange traded funds with the MACD, the returns, and you can project forward the returns, you can just say, look, is it going to have that angle of attack again, that angle of growth, which would be something like this? And you look forward 12 months and you say to yourself, well, hang on, that is probably a 20% return max. Yes, that's what's hidden in exchange traded funds. People don't realize that the returns can be quite low. Okay, Apple, I'm still in, and this is the problem with most of the holdings at the moment. They're a bit overbought. So would you buy more cautiously because it's overbought? Would you hold? Yeah, there's no reason to sell. Would you sell? No, because there's no reason to sell at the moment. It's not a daddy bear as such. But also, it has these wonderful statistics. Oh, this I love. We know with Apple, from the statistical analysis, it is buy more if it falls stock. Okay? Buy more if it falls. Most people panic when it falls. I get excited when it falls. And so does Warren Buffett. Buy more when it falls kind of stock. What about Nvidia? Right? It's in the news. It's a mummy bear. What's a mummy bear? The prices are falling and this is falling, as it did here. It's happening there. Now, don't read too much into it. Does that mean it's necessarily going to fall through? No, doesn't mean that at all. Chances are it's probably just going to kiss its own blue moving average and go up. So don't fall into trying to predict too much. It is going through a mummy bear at the moment. You can tell from that and that. That doesn't mean I panic, but it hasn't fallen enough for me to want to buy more. Because if I buy it when it's just dropped 10, 20%, I'll be overexposed to it. If I buy it when it drops 30, 40%, then I'm getting a bargain. I don't mind owning more of it at that price. Okay. And we can see from the data, we want to buy the dips on this, but maybe not a 10% drop. Even an 18 might mean I've got too much of the stock in my portfolio. I don't want to be outweighted. But a 40% drop, hell yeah, fill your boots. Okay. Meta is a similar kind of story, except a bit more developed. It's actually a daddy bear. So if you were risk averse, you'd exit because it's a daddy bear, but you might have to buy back more expensive later. But at least you'll protect yourself from a prolonged drop as happened. Whoops, here. How do you decide what to do? Your regret minimization. See? Look at that. More portfolios already mentioned. That's if you just held those, let alone anything else. Now, the reason you wouldn't just hold 5 stocks is that is way more than I would want. That's why you wouldn't just hold 5 stocks, even if that looks good. And that's the mistake that a lot of private investors make when they see these newsletters. Oh, we got this return, we got that return. Yeah, they don't tell you about the drawdown, which you would not have survived, do they? Okay. If you want interest, this is in the public domain. I share it with my clients anyway. It doesn't mean I go and buy these stocks. It just so happens what they happen to own. Okay, I don't own all of these by any means. What I want to do is tell you a couple of things about how we do things then. Just wrap that up a bit. 9,000 stocks, value growth, that gives us quality, multi-factor, not just one. Okay. Momentum, statistical edge. That was me in the Financial Times getting that. What we're trying also to do is not to try and pick bottoms and tops by having a systematic process whereby stock A and stock B ideally dampen each other's volatility out. So we get that. Got 2 stocks which are both rising, but they're moving inversely to each other. You get a straight line and the rise. What about diversification? What's the right number? After you get past 40 stocks, there's very little point holding any more. So diversification is what happens, is what, again, fund managers underperform. They have so much capital that what they have to do is spread it and pray across a lot of stocks. In fact, what they do is they have a benchmark they're given, and they look at that benchmark index and they look at the stocks in it, and then they buy a bit more of one and a bit less of the other, and they start gambling on one or two companies outperforming, and that way they can beat the benchmark, because their first concern isn't your money. Their first concern is their career. And their career, they survive if they can hug the benchmark. If they come too far off it, for too many years, they get sacked. They're playing with your money to gamble on trying to beat the benchmark by guessing which stocks in that benchmark are going to outperform. We don't do that. We'll give you all the data. You manage your own money with the data and the know-how, and you hold it without having to have any of those conflicts of interest that those bloody fund managers have. Due diligence checklist. This is what we do for due diligence. You want some kind of valuation metric, whether it's price earnings or price earnings growth. In a way, I almost don't care, as long as you've got some metric for that growth. And when you're weighing these things, that should have about a 40% weighting, or maybe 35% weighting. Growth, at least 20-25% weighting. According to the literature, it's more predictive if that's the case, whether it's sales growth, earnings growth, or cash flow growth. And then you can look at dividends and earnings for the income. You want momentum, and you want a high Sortino as well, and you want to try and have low correlation in down markets. Okay, and the reason so many of my stocks end up being American or NASDAQ, look at the wealth gap. We took a 5-year period, and virtually any rolling 5-year period ends up looking like this. Okay, and that's what happens. So the Americans who invest in their domestic markets, their pensions had doubled by 2020. The Brits from 2016 to 2020, who invest in their domestic markets, had seen their pensions drop. I chose those two periods randomly. It wasn't because I thought, oh, that'll really widen it out. Okay, and that's usually the trend. Over any rolling 5-year period, that's what happens. I know you're thinking, well, what about this year? The UK did really well. Yeah, it does well some years anyway. Okay. We're trying to, by giving that process of knowing, well, we've got a model portfolio, we're going to hold it for about 3 years. Therefore, we don't have panic attacks and stress. Okay, and I'll give you an example of a model, right? If you look at, so we created polls, right? Whoops. Right. We want to keep that risk and drawdown. We want the drawdown to be as low as possible. The volatility I'm less concerned about. The risk I am more concerned about. Okay. And within that, what we're trying to get across is the underwater period is when you get bored. It's like 7 months, I've not made a return. Drawdown is when you panic. And if we show these figures already to clients, then what usually happens is they're able to turn around and say, I don't need to panic or get bored because you've already showed me. What if the sausage is what's produced is the 26.9%, then what goes into the sausage, the individual companies, when you look at those, you don't need to panic or get bored when you see so frequently how much they can drop. So we give that data month by month. And the reason we do that level of hand-holding for each client is because, as Warren Buffett said, is people who can't take a 50% drop in their stock holdings have no business being in investing. And the reason he gets that across, and we handhold that to people, is because they're crazy. They don't see how important it is to have more realistic expectations. So don't forget those free tools. Okay. I've already mentioned those. That's what a typical fund on average returns, sadly, in the UK. 5.3%. Pathetic when you compare the numbers that we're talking about. Okay. And the problem is people have never been taught. The Goldman Sachs cash return on capital invested formula, I absolutely love. It's the one I got at a lunch with their chairman many years ago. And it's one of the ones that has to tick our box when we're looking at stocks that we like. It has to tick the box, croaky. Why? Because companies generate 30% per annum in that Okay, these tools I've already mentioned, so you don't need to see that. Is it then little wonder that pension lump sum withdrawals have absolutely gone through the roof? People are taking more money out. Now, part of it was because they're worried about Rachel Reeves and what she might have done, sort of a socialist raid on people's pensions. But part of it is they're fed up with what fund managers are doing. I know this because they tell me, people tell me. And that's me. Those are the books, the data, and everything else I've got. Do follow me on LinkedIn. I'm going to show you something else. And do have a look at, that's me with the gang at number 10. Do have a look at the various links on there with lots and lots of free material. But I want to show you some things. Please be careful when you're looking at journalists, because their job is they get paid for writing by the word. Brokers just want you to trade because they earn commissions that way. Fund managers want you to buy their fund because they're paid on assets under management, conflict of interest. The banks, they can move the markets, but if you've got 50 million, they'll do it for you. Okay. So just be careful of those routes. I've had about 200 columns in the Financial Times now. So everything I've told you has been published. And in that sense, this is before the age of verification was verified. It's not that I've come up with stuff and just said, oh, look, we should do this. That's that competition. It's this one. Okay. Woodford, 14th. We have to forecast the FTSE 100 over a 12-month period, which requires some knowledge of the stock market, requires some knowledge of macroeconomics. The guy's an idiot. Jasper the Cat, which was picking numbers by random, came close to Neil Woodford. Absolutely insane. Okay? And you might have seen me do all of that as well. I actually think you can be better than those people. I think you can learn to drive. You can manage it yourself. It's relatively simple. Get the data, filter, make sure the drawdowns are below. Boom, done. If you're going to do it yourself, and then value, growth, income, cash flow, Sortino, etc. By the way, for those talking about correlation, somebody was earlier, the Dow 30 companies in the last crash, look what happened. Where's the correlation? They all fell. So this 2 weeks ago is not literally 2 weeks ago. It's this I wanted to show you. In the last major crash, how come they all fell then? Where's your correlation? Well, because you've got to pick different sectors. Really? How come Johnson & Johnson and Apple fell? What the hell do they have in bloody common? So correlation when you need it the most isn't there. Like I said, the due diligence checklist is that. Fund managers, problem, they don't share. They put it in a black box. They think they can beat the market, which they can't because their hands are tied behind their backs and they can't just have the stocks which are beating the market. They end up having to pick the whole benchmark and then try and go one or two beyond it. So they buy the whole bloody benchmark and then have an overweight holding in one or two. They think they gamble with your money will rise. Well, that's not the way to do it. This, we think, is the way to do it. Systematic, evidence-based, show you all the data, give you the education, let you then do it directly. So it builds your competence as opposed to you being dependent and paying a fund manager. Simple as that. Okay. Seems to make sense when somebody explains it afterwards. I've already explained that chart. I think I've explained that as well, which is similarly that one. Okay. Why Croaky? Because that 30%, that's from Goldman Sachs Wealth Management. But I need to tick that box. Okay. We want companies with generate lots of cash on the capital they invest. It's as simple as that. So if you're interested in being on the program, then I'll give you a link in a moment. I take people onto the program 10 at a time at the webinars. And what I also do is we have get-togethers and so on. If you're on the program, because what we're trying to do is avoid people doing this absolutely awful, typical £10,000 moderate scenario, average return per year, 5%, absolutely bloody awful. Luckily for us, that's our competition. And you can imagine why it's easy to beat. Hard to kill, easy to beat. That's what we offer. Most importantly, what people want is that they want the one-to-one Oxford-style tutorials with me. Yeah, I know. That takes a long time for it to sink in with people. What? Directly with you, mate? Yes. as well as, of course, they get all the data and everything else. I'm going to look at some questions and answer them as well. So I'm going to do that. I'm also going to put some files up. So the book you can have as well. I'll put that up there. I've had quite a few reviews, as it were, for my work over the years. Lord Peter Krillis now. And so on. Sort of Columbo meets Warren Buffett. Shares Magazine, thank you. So that's it. That's it. Now I'm going to answer some of your questions. I'm going to put the link up where if you want to be part of the program, you can be part of the program. My aim is to create a different kind of asset management company and list it on the stock exchange, create something which replaces the St. James's Place, because the power should not be with their expensive managers who underperform benchmarks. The power should be with you to pick a broker to buy the portfolio which suits your drawdown, because you're educated, informed, you've got the data, and you know how to do it because somebody gave you the data from which you both created, very simple, the model portfolio. And then you sat back and you were calm, cool, and collected with it. Simple as that. That, in a nutshell, is what we do. Okay? So, and to avoid conflicts of interest, unlike a newsletter, which keeps giving you a subscription, which you have to keep paying for, and so they have to keep telling you to buy something even if it's rubbish, because otherwise you'll say, oh, where's my paid subscription? Where's my rubbish stock to buy? In a falling market, you should be holding cash. The way we keep it without conflict is you just do it once. Pay once and have lifetime access. There's a new company which has people like Jensen Huang doing the education on I think it's called Augment or Audacity. I don't know. It's something similar to that, begins with AU. And they want the same model, and they got 6 million in venture capital funding. And the founder said everybody thought we were insane having a pay once. And I think it's the way the market's going to go, so people know where they stand. They're not beholden forever, and there isn't that ongoing conflict of just having to serve for no reason. Although somebody had said on TikTok, yeah, but what motivation do you have to keep performing? And I was like, bloody hell, how about a lifetime reputation and a public figure? Why would you not want to perform and produce the best, and that you want to keep going? We live in a world where if you don't perform, some people will just say, hey, this guy's not performing. So that's what we do. That's where you go. Okay, if you want. And now I'm going to answer your questions, because I know there are questions from people. Sorry, it's gone on a bit too long again. I'm also going to put up all the other slides. Flyers, documents, PDFs. You should be able to see them. They should pop up on your screen. I don't know how many do at any given time. But I've also got the chat. So let me make sure that on the chat, people can hear me. I should say also, if you go to campaignforamillion.com, the website, okay, there you go. You will also find on there all my free links. And you can go there and see everything as well. And you'll see sort of reviews and stuff. So there we go. And there's a ton more free content. Oops, on YouTube. I think she's just changing that today. Better check in with her. On the site, here we go. Thank you. Right, questions on there. And don't forget, you can find me on LinkedIn as well, because I occasionally write content there as well. Oops, there you go. There's the on Campaign for a Million. There's the YouTube pages and stuff. And we've got the latest TikTok ones on there as well. 453,000 followers on there. Isn't that good? Oh, that's good how that sort of appears there. So you've got one place where you can find Fix Your Pension, why St. James's Place are rubbish, blah, 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 and so on. And that. And you can see 279 subscribers, 453 That's rather good, isn't it? We've had a new design. So that was my talk at Canary Wharf. You can see over there. So on the page, I'm going to show you something else, how it's done in the recent past. So 2024, we'll have 2025 figures in a month. Now, if we were clever, obviously 515%, we would have picked that and nothing else. That was because it was on the filters. Okay, if it's on the filters, it's there. Those are the returns. And 2023. But then the market went up so much. So obviously our life was easier. In 2022, we had to stay in cash most of the year, so it was 0%. Having said that, the market dropped a ton. So we did better than that as well. In any event, we did better than the markets. And if you want to know, like I said, in simple terms, that's what it is. We do all the data and the donkey work for you and handhold you. So it's a cross between an Oxford University tutor and a driving instructor. Thank you, my friend. And you were there at my talk. So we have events where we invite clients. Robbie's a client, and we invite Anna, a friend. Try and make clients into friends. Where is he? Where is he? Where is he? Where is he? Oh, I want to try and make that sort of. I can't do it. See if I can invite you as a presenter even. There you go. Get between life changing education and model portfolio. So much Alpesh and mentor. Thank you, my friend. Couldn't recommend the program more. I really appreciate that. Any tips on starting up your own hedge fund? Yeah, I've got an article. Well, I've got the process you use to do it. It's at investing-champions.com. Aaron. Go speak to Simmons & Simmons, the law firm. That's who we used to set up the fund. And I'd say the most important thing with setting up a hedge fund is having the capital lined up, like any business. So make sure you've got the capital lined up. And you probably need at least, I'd say, 20 million of assets under management in order to make the fees work, the 2 and 20 fee structure work. So that would be my top tips. Simmons & Simmons, and make sure you've got 20 million of signed up. Excellent, insightful overview as always. Alpesh, big thank you. Must go. Goldman Sachs time for SB is 7K, and Elliott Waves put it around 7.2. Interesting. Any coin. I wouldn't disagree. I wouldn't, kid, I wouldn't disagree with that at all. I don't see an obvious reason to say, oh God, they're so wrong. It's a red flag by any means. I'd be very positive. If anything, I think I'm too, I'm holding back my enthusiasm too much. I think that's the danger. It doesn't come across that how excited I actually am about the potential for the direction it could go in the market and how much higher it could go. But then I think when you get a bit older and weathered, you're sort of a bit more cautious about just going nuts over things and saying, oh, it's going to go up. It's going to go up. If there's any other questions, all gold. Thank you very much, Carwin. If there's any other questions, just email me. Okay, people. But I'm really excited about this and what we're doing and where we're going and the direction of travel. So really pleased. If you've got any questions, just email me, as I said. And don't forget to have a look at all those links. So thank you all very much. I'm going to go and maybe just check the US Open. We've just timed it perfectly. Okay. That we've got the Open coming up. US Market Open coming up. Thank you all very much.